All right. Well, thank you guys for joining us on the webinar tonight. I'll go over a couple of quick housekeeping items before we get going here. One of those things is there is a Q&A button, top bottom of your screen. I don't remember. Sometimes it depends on what platform you're on, but there's a Q&A. So if you have any questions, you can pop those in and we will try to answer them as we go along. If not, we'll try to get them at the end. If there's a ton of questions, then we might have to get to you afterwards, but we always try to get back to you as quickly as we can. So if you have any questions, make sure to do that. And then secondly, for those of you who may not be able to stay on the whole time, we are going to be recording this and we will send out the recording. So you'll have an opportunity to review it as well. So feel free to take notes, but we are going to record it for you. What did I miss?
No, I think that's good. Okay. You usually have your disclaimer slide. We can go through that one.
Oh, yeah. We'll have that in a second.
Okay.
Yep. All right. Well, hopefully everybody's here.
Yeah, I think we should start regardless, and in fairness to the people that are here. So let's go ahead and get rolling.
Absolutely. All right. So we've got for those of you who watched our webinar just about a month ago on the Cincinnati property, this is our second one for 2020. And as typically seems to be the case in this business, the first half of the year is pretty busy. So we are off to a good start, but we're excited to share this deal with you guys. It is kind of a similar deal to the one in Cincinnati, and we'll talk about details, but we've got a rough, 60 to 90 day time frame here in terms of the actual opportunity itself. So let's jump in without further ado and talk about what we've got here. So this particular property is right in our backyard. If you remember, for those of you who may know, we have another property in Sarasota, which is also in our backyard. The Sarasota property is a tax credit property, so it is fully limited on the upside for the rent. This is a market rate property, and of course, we're always happy to get market rate properties because we have the ability to raise the rents a lot more. So that's what we're going to do here. Now, the one nice thing about Bradenton is that the entire area is experiencing about a 3 times growth rate versus the national average. So as we think about that in terms of multifamily, of course, that's a positive thing for appreciation. Now, as you know, neither Rod nor I build the business plan on appreciation because that's a high-risk strategy, especially in this market. But I will say that over the long run, I think we're going to see a lot of that in a market like Bradenton, Florida, the Tampa area. And I guess I should say that for those of you guys who don't know where we're based, it's basically the Tampa Bay area on the west coast of Florida.
That's the MSA. That's the large MSA that we abut, and then we're south of that in the Bradenton, Sarasota market.
Exactly, yeah. And it's actually a pretty good size area. There's about 2.5 million people in the Tampa MSA, and we've got about 500,000 just in the Bradenton, Sarasota MSA. And some of you guys who've flown a lot, you've probably seen ads on Delta. I think it was Delta where I saw it for Lakewood Ranch, which is essentially like a third market in between Bradenton and Sarasota. It's an extremely popular retirement, but not just retirement, families, all kinds of people moving.
Lots of families, huge community, growing like crazy, very desirable. Yeah.
It's a little insane. We actually live on the north side of Lakewood Ranch, and in 3 years, it's gone from reasonable traffic to just absolutely insane traffic. So the growth is beyond crazy. But anyway, so that's where this property is. It's in this Bradenton, Sarasota area. It's a 92 unit, and of course it's got some value add, which we will talk about. It's basically a C-class property, although the area is becoming, I think, more of a B-class area, and I'll explain why in just a minute. But it's a good, solid C-class value add opportunity. Now, it's not a huge property. It's 92 units, a little bit
It's
smaller
actually
than,
smaller than we normally target, but
right.
it's in our backyard, and we love our backyard. So it was kind of a no-brainer for us.
And it's one of those things too, where you're seeing in this market that, especially in a hot area like Florida, the larger deals are just getting priced crazy high. And so you almost kind of have to, you search for that middle ground where, typical operators like us won't buy a 90 unit and a smaller guy can't afford it. So we kind of have a little bit of a niche there to try to step in and take some of these, smaller for us deals.
Yeah, if they're in our backyard, we can effectively asset manage very, very easily. And this property is 25 minutes from my house.
Yep.
So, and lots of exciting things happening around this one too. So you're going to get into all that.
Quite a lot. So the highlights here, just to give you a quick overview. Again, most of you know this, but I'll just review it for those of you who may be new. We have a minimum investment of $100,000. Now I put a little star there because we do accept lower amounts, but there's a little bit of a different split on those lower amounts. So we encourage everybody to invest at the $100,000 minimum. Our typical investment term is 5 to 10 years. Now that's a pretty big range. And again, for those of you who are newer to our sort of platform, if you will, we say 5 to 10 years because we're looking out long term, and we don't want to have the expectation that we're going to sell in 3 to 5 years, because we believe that if there's a correction in the market, let's say in the next 2 or 3 years, we're not going to want to be in a situation where we're trying to sell a property when the valuations are down. So we want to put ourselves in a situation where, regardless of what happens out there in the market, we've got a good quality asset with some good cash flow. And if we need to ride it out a few extra years in order to maximize that return, we can do that. So that's why we say 5 to 10 years. Our projected annual cash on cash is 9 to 10%. Now, some of you who have seen our other deals, let's say in the Midwest, you'll know that that's a little bit lower. And that's fairly typical because we're in a Florida market. We're in a very high growth market. So our Midwest deals will have a little bit higher yield and a little lower growth. But Florida, as an example, very high growth. And so the yield is a little bit lower.
And we underpromise. That is our framework. We underpromise with the anticipation of over delivering. There are 80 million baby boomers in this country, and I like to say they're getting old and they're getting cold. And so Florida is in the path of that mindset. So keep that in mind.
Yeah. And speaking of that, conservative nature, those of you who got the email, you noticed on the projected IRR that I had 15 to 19% on the IRR. And I actually decided to just stick with 15%. And here's why. We really never project appreciation on the property outside of a very low 2 to 3, well, not even a 2%. It's more like a 1% appreciation. And on this property, I modeled some appreciation because it is Florida. And I initially thought about presenting that. But, guys, I'd really like to stick with our model, which is just to be conservative. So 15% is still a great number. We're very happy with that. I mean, that meets our criteria. Do I think there's upside from there? Yes. But I'd like to just set the expectation that that's what we're going to shoot for. And again, if the market does great over the next 4 or 5 years, we're going to exceed that, no problem. But, if we have a correction or a normal market cycle, then, we don't know what's going to happen. So anyway, that's where we're at on the projected IRR. And again, for Florida, for us, we are very happy to get a 10% cash on cash and a 15 IRR in a market like this.
Carlos is asking if we share detailed pro formas with passive investors.
Yes, we do. Yeah, mm-hmm. If somebody wants to see our underwriting, we're more than happy to share that with you.
And his other question is the cash on cash net to passive investors after override. Could you explain that?
Yes.
You do a better job of that than me.
Yep. No, that's a great question. And thank you for asking that. I always forget. So anytime we talk about returns, it is always in your pocket. So not before any fees, not before any nothing. Because in other words, in our mind, we're an investor alongside of you. And so when I think of returns, I think of what am I getting if I'm investing in this project? So Thank you for asking that. Yeah, all of our numbers are always after all the fees, all the working capital factored in, all the fudge factor that we do, and you'll see that as we go along. So,
and they are return on capital, not a return of capital. Very, very important as well.
For what? What did I miss?
Well, the return, the cash on cash return is a return on your capital. It's cash on cash.
Oh, yes,
It's
right.
not a return of capital.
Yeah, well, there is some return of capital. Okay, sorry, okay. I thought somebody had asked a question. Got it. Oh. Okay. All right. Yeah, because there is a point where we do the return of capital to save on taxes, but that's a different issue. Yes. Okay.
Right. Okay.
All right. So this is our standard disclosure. Really, here's the bottom line. We are doing this as a 506C opportunity, which under the SEC regulations requires that everybody who's an investor is also accredited. That gives us the ability to market, but also limits us to accredited investors. Now, for those of you who may not be familiar with that term, just means that in summary, you need a $1 million net worth exclusive of your personal residence, or $200,000 in income as a single, or $300,000 as a married couple for the last 2 years. So won't belabor that, but that's really what that's all about. So let's dig into the area a little bit, since some of you may not be familiar with Bradenton, although you've probably been to Clearwater, St. Pete. I know a lot of people that have been to the beach, and Bradenton, Anna Maria is all part of that sort of beach area. One of the interesting things about Bradenton, which most people don't know, is that we have a lot of jobs coming into the area because of the very high access to both local and global markets. So the Port of Tampa, which granted it's 30, 40 minutes away, but the Port of Tampa actually opened up a whole bunch of new lanes coming through the Panama Canal. So Tampa is now, and actually the Manatee Port is now the shortest distance for cargo that's coming out of the Panama Canal. So that was a big win for this area. Now, in addition to that, you also have a lot of railway. We have a couple massive CXX railway yards, and we've got the I-4 corridor. Some of you guys who have looked into the Florida market know about that. Big, huge growth area. And we've got 3 major airports that support that commerce. And it is interesting because, you know, you look at an area like Tampa and you've got 2.5 million people, where normally you'd have one decent sized airport, but we've got 3 significant airports and just tons of flights. So from an ease of access for people to come here, work remotely, work locally, it's really becoming a very popular destination. So that's driving jobs. Now, you know, my second point here is that we all know jobs drive multifamily, and we've got a pretty highly educated workforce. 38% of the population holds a degree. And along with that, not surprisingly, 63% of the people have, you know, what we would consider a white collar job. Now, our particular complex is not targeting necessarily white collar jobs, but the whole idea here is that as your income levels go up, then your rents are also going to go up as well, and your valuations. So that's you know, the kind of the driving force behind it. Another interesting fact about Bradenton is the key business sectors are both diverse as well as kind of on the higher paying side of things. So we've got advanced manufacturing, we've got aviation, aerospace, defense, a couple of corporate headquarters, life science, sports performance, and tech. So a lot of kind of niche industries that I think have some competitive advantages. Some of the reason they're here is because of the tax benefits. Some of the reason they're here is simply because they love the weather. In fact, I've got a couple of friends that are CEOs of different businesses, and they've moved their companies one from Canada and one from Michigan, pretty much simply because they wanted to be here to enjoy the sunshine. So not surprising. But so that's a little bit about Bradenton. Now, from an economic standpoint, tying into the whole bigger picture, very strong job growth. So this 2.4% job growth is, it's not double the national rate, but it's about 60% higher than the national rate. So very strong job growth. The unemployment rate, very strong, in line with where we would expect. And then the future job growth, even though it is an expectation, this is similarly about, I believe, 50% higher than the national expected future job growth. So there are a lot of jobs coming into the area. The expectation is that that will continue. The reasons are because of the access to transportation and moving the goods and being able to work remote and the weather and, you know, all those kind of things. So we do expect to see, for better or for worse, that it's going to get busier in Bradenton. So if you live here, it can be good and bad. One of the other things I always like to point out is just kind of give you a visual of the area. If you saw our YouTube video, you got a little bit of this. Our media guy, Adam, did a great job putting this together for us. But kind of from the aerial view, the letter A is the apartment complex, sort of at the lower part of the screen there. The top part, up where letter G is the downtown Bradenton area. E is Tropicana. So Tropicana was actually founded and used to be headquartered right in Bradenton. They since moved the headquarters up to, I think, Chicago, because it's, you know, it's owned by PepsiCo now. But they still have pretty much their entire plant here in Bradenton. They still process close to 4 billion oranges a year. So they crank out a lot of orange juice. But other than that, you know, we've got other major employers. Workforce Business Services is another big company. They actually are one of the largest workers' compensation and PEO companies in the country. And of course, we got the usual Home Depot, Lowe's. Bell's is actually a clothing retailer that is headquartered in Bradenton as well. They're kind of like a TJ Maxx, but on a smaller scale and more in the Florida market. And then, of course, we've got our Lecom Park, which is the home of the, oh gosh, now I'm going to look like an idiot. Rod, help me out.
I don't know. I honestly don't know.
The Pirates. Oh God.
Oh, there you go. That's right. So that's spring training for the Pirates. Yeah. But I want to mention something here, guys, and that is we look for significant employment diversity in any submarket that we're in, and you can see there's plenty of that here, and that's just really important. If you're evaluating a submarket, it can't be a one-horse town. You know, one big employer that's pretty much the financial legs on that area, and even a military base. You have to be very, very careful. So we're always looking for employment diversity, which this little microcosm here absolutely has. So
yeah, it's unusual, I think, in the sense that it's not just based on tourism, which is a big part, but it's significantly not based on tourism. So we like that. Yeah, 100%. One of the things I want to point out on this map, kind of in the middle of the map, just to the left of the letter A, where the apartment complex, there's a little dot there for DeSoto Square Mall. So we didn't really factor this into our projections, but there's a 58 acre, basically dead mall that is sitting there. And for the last few years, it's supposed to be redeveloped, and the guy who bought it has defaulted on his debt and can't come up with the money to do anything. And about 2 weeks ago, the bankruptcy court, I believe it was a bankruptcy court, finally said, look, buddy, you either put up or we're giving this property to your lenders. Now, the lenders are chomping at the bit to get this thing because they've got $22 million in it, which is nothing for that prime real estate. So we're all feeling pretty positive about the fact that over the next maybe 6 months, this whole redevelopment project is going to start moving. And if that happens, I think that's going to have a tremendously positive effect, both on the area as well as the Palms at Cortez, the complex that we're buying. So that's one of the things that we're, you know, kind of in the back pocket, if you will. We haven't planned for that per se, but I do feel pretty confident that it's going to happen. That's going to really improve the entire area. So that's one of the sort of side stories.
Was this an off-market deal from a broker?
This was, yeah, it was off-market. It was through a broker, but we actually had a relationship with the sellers. So it's kind of a quasi.
Somebody asked that question.
Okay.
Okay. Yeah. Thanks.
Yep. Yeah, so it was a little bit of a relationship,
Right.
rather than just a true marketed deal. But anyway, so the other thing that I want to mention too is there's a 44th Avenue West. And again, I don't know if you can see it, but it's kind of at the bottom of the screen there. It runs left to right, east to west. And the city, the county, is actually extending that road all the way out to that Lakewood Ranch that I was telling you about. So this is going to be a major artery for traffic going back and forth from the beach to downtown, all the way out to Lakewood Ranch. And that is also going to bring new business and traffic to that area. And again, those are the kind of things that we look at as a positive development towards improving the area where these apartments are. So a couple of projects. Again, I'm not going to go through this in detail, and we'll give you guys all of this later when we send the follow-up email. But there are a lot of different projects that are happening in the Bradenton area specifically. I mentioned the 44th Avenue project. That's going on. That's a $162 million project. The museum, South Florida Museum, is currently going through a pretty good size expansion. There's a new Spring Hill Suites that was completed about a year ago. They redid an old historic hotel. The marina was redeveloped, and then downtown Bradenton, they're redoing a whole bunch of stuff. So it's a lot of cool stuff that's going on. If you want to find out more information, I put a website there. It's called Realize with a Z, realizebradenton.com. They've got a cool video and all kinds of nice stuff there. And it'll give you some good reasons to come down here and maybe spend a little vacation time too. So, but it's just, you know, the whole goal obviously is to not just make it conducive for tourists, but make it conducive for everybody in the area and make it a really nice place. So area demographics, again, this is something that we like to look at. It's not a end all be all, but it's a great source of information relative to what we're doing. So the monthly average rent of $1,180 for a 2-bedroom, which is very similar to where we're at right now at our property. Now we're going to be taking this property to, I'd say, more of a C plus B minus level. So we're going to be a little bit ahead of that average monthly rent at some point, but that's where we're at today. And of course that includes all the way from, you know, the C minus, the D's, all that stuff, plus the A's. So that's your average monthly rent. Now the other interesting number that we look at is the median house value, $257,000. So one of the things that we like to see is that the purchase price per unit that we're buying our apartment complex for is much lower than the median house value, because typically if that's the case, it's going to be more difficult for somebody to move from an apartment into a house. So we're buying it for about half of that median house value. So sometimes, you know, we can get a 3 or 4 multiple, well, probably not a 4 multiple, but anytime it's more than 1.5 times, we know that we're usually in pretty good shape. So this meets that model, and it's about half of that median house value. Now, another thing that's important is the median household income. Now, I will tell you that the immediate area around the complex is not $61,000. That is the general area in that zip code. Actually, I think it was the city in particular. But the point being that the median household income can support the rents that are being charged. So that's another factor that we always look for, because you want to have at least 3 times the income versus the rent that you're charging. And so that's something that we always like to consider. So that's the area demographics. Now, another thing that we look at is the unemployment. And of course, we go back to 1990 and feel that's a good, you know, almost 30-year track record to see how things performed. And I would say if you look at the zip code where we are back in the recession, it did about the same as the overall state and metro area. So it didn't outperform, but also didn't underperform. One of the things that we're noticing in the zip code is a lot of revitalization. So this particular area about, I don't know, 15 years ago was a little bit blighted, maybe 20 years ago, I would say at this point. And the county and the city really said, you know, we want to come in here, we want to clean this up. So they first brought in an arts district, and they took a whole section of Bradenton and dedicated to an arts district. And as many of you guys know, that's kind of the beginning of these things happening, is you get some of the more, you know, the creative folks to come in, fix up the old houses and start to turn the neighborhood around. And so that started about 15, 20 years ago, and it's extended out. And so now the area where the complex is right in the middle of this revitalization that's happening with the retail and the multifamily around it. And so it's really turned into a nice area. So my thought is going forward, we would expect to see it perform at or better than the metro and the state area because of that improving demographics in the area. So, all right, so let's talk about the property a little bit. Again, there's kind of three main things. Well, I guess I'll just tell you about the units in particular. So we've got all 2-bedroom, 2-bathroom floor plans. There's 8 townhomes and the rest are apartments up and down. And the current ownership has a pretty large portfolio. They've got about 20,000 units, and they've changed their focus towards more larger, properties. So 200 plus units, and their geographic focus is not in Bradenton. So they don't have any other properties in the area that really fit what they're trying to do. So that was kind of their impetus for moving this property along. I think on a personal level, they were also struggling with the on-site management because they had a lot of turnover. They had issues with the P&L, and I don't know. I'm not sure why they didn't just fix it, but be that as it may, I think it was sort of a thorn in their side, and they said, you know what, for 92 units, why are we bothering? So that's kind of how we came across the deal. We had a good relationship with the local broker, and we also knew the seller, so that helped us to get it off market. Now, as I mentioned, the current management had a lot of challenges in the last 12 to 18 months. So the P&L wasn't very good. Unfortunately, that doesn't help us with regard to getting our debt structured. We'll talk about that in a minute, but we do feel like the opportunity's there. The numbers are moving in the right direction now, and I actually just got the latest financials today. So I can say that they are moving in the right direction, which is great. But I think the biggest part of the management play is we're bringing in a very reputable group, Weller Property Management, who's a local St. Petersburg company, and they are actually going to be our property management company. So I'm very excited about that. One of the things that is always extremely important is the regional manager that you get. And that was one of the key selling points for me, was just the regional person that they had, who was very sharp, knew his stuff, knew the vendors, knew what was going on in the area. So I think we're going to have a really strong team, and that's so important.
Critical.
Just absolutely critical. Exactly. So, and we talked about the goals for the property. We talked about what we want to do. They're 100% on board. They said, yep, we get it, makes sense, and we think we can help you guys make it happen. So we feel good about that. Now, with regard to the renovation, that's kind of the third piece of it. The existing ownership renovated 8 of the existing units. We're going to complete that renovation, and we're also going to do a little bit of landscaping, but also some marketing. I don't have a picture on here. Actually, it would have been good if I did, but there's a long entryway that is straight off of the main 4-lane highway. And there's literally there is signage, but I mean, you almost don't even notice it because it's so buried and ugly. So there's things like that that are going to help. They're not doing a whole lot to market in the area. They're doing a little bit of Facebook campaign now, which is good, but we will, continue to really accent that and make it maximize the value. All right, so a little bit about the property detail. Built in 75, in 92 units, which I mentioned. The roofs, thankfully, are all brand new. They were just replaced about a year ago, I think, year and a half ago. So we're good there. Slab on grade construction, typical vinyl siding and stucco. It is a block construction, so that's
CBS.
nice.
Yeah, concrete block. So
always a nice thing.
Very, very little hurricane worry, and that's probably why I got new roofs, because we've had some storms over the last couple of years.
Yeah,
so, all good.
That's true.
Yep.
You're probably right. I hadn't thought about that, but yeah, that's true. Plumbing is a combination PVC and cast iron, which is fairly typical for this vintage. The HVAC is central, and the wiring is mitigated aluminum. Most of you guys know that on the properties that were built in the 60s and 70s, they put aluminum in, then they had to come back and mitigate them with a Alumicon, copper ending, whatever, stuff like that to make it safe. So that's been done here. And then the only thing that we're going to do is we're going to actually go through and replace some of the old electrical panels where we feel like it just would be good. And actually it's an insurance thing too. The insurance company will give us a break on the insurance if we go through and replace some of those panels. So we've also factored that into our CapEx budget. So I feel like there was something else here I wanted to say, but I can't remember. I'll come back to it. Oh, I know what I was going to say. On the water, kind of an interesting side note, every single one of these units is sub-metered for water. Now, we're not planning to go back and build them for water, but it is a potential opportunity for us to look at doing something along those lines because we have all those sub-meters right there. And it was interesting because not even the current ownership had noticed that they were all sub-metered. So I don't think anybody has necessarily talked about that. And it kind of makes me wonder if originally they were thinking about doing condos.
Yeah, condo conversion. It's likely what they were planning on doing at some point. Yep.
So that's interesting. Property amenities, pretty standard. We've got a clubhouse, barbecue station, picnic area. It's a gated community, has a pool, as you can see, and it's got laundry. Actually, it's not laundry facilities. It's actually washer dryer units in every single one of the units.
Every unit's got its own washer dryer, which is
exactly
which we love to see whenever we can.
Yep. So hang on. All right. Area amenities. This is probably going to be a little hard to read on a small screen. So again, you guys will have these slides. We'll send them to you later. But this is kind of some of the things that are going on around us. We have a couple of big hospitals. We've got the mall that I was telling you about that's going to be redeveloped. We're 10 minutes from downtown Bradenton, 15 minutes from the beach. We've got a State College of Florida in the area. IMG Academy is a major sports training, I don't know what you call it. They do all kinds of stuff.
It's a big deal. It like your notes here, attracts 12,000 athletes from around the world annually. It's a big deal.
I
had no idea how big a deal it was, but I hired somebody that used to work there and filled me in. But
they're cranking it out.
Yeah.
Okay, so unit mix, like I said, it's 2-bedroom townhomes and mainly 2 bedrooms, fairly good size units. And we're currently at about $1.24 per square foot on the rent. And the floor plans here, you can't really see it, but bottom line is the floor plans are pretty good. They've got
they're laid out nicely. They're not bad at all. So
I guess we have some pictures in here.
Real pleased to see it. They're reasonable size. The rooms aren't too small. Really, very pleased with it.
It's nice. It's not functionally obsolescent.
Right.
So the business plan is essentially complete the renovations from the 8 units to the full 92. And then secondly, to take our high expenses, which they're getting a little bit better, but obviously we're going to complete that process by bringing things back in line. And then the last piece of it, which I didn't mention yet, is every single unit has a washer dryer hookup and washer and dryers, and they are not billing anything for those washer dryers. Now in this market, it's very typical to bill back for washer dryer rentals. So that's something that we do have in our projections that we want to start doing, is when we do the renewals or when we bring in new folks, we're going to start charging for those washer dryer units. So again, that's very typical in this market, and that's going to give us a little bit of rent, a little bit of incremental revenue as well. So not huge, but it'll certainly add up over time. One of the things that you guys know we always spend a lot of time on is our rent comps. There are quite a few properties around us. Most of the older properties are more of a C-. They're pretty rough. So they really are not a comp to us. So we're comping against some newer properties in general. Now, most of these newer properties have not been renovated. So when we renovate to our granite countertop, stainless steel, nice lighting package.
Vinyl plank flooring,
right.
Plumbing fixtures, lighting fixtures.
So some of these units are going to they're going to be a little bit older. They're going to look a little nicer from the exterior, but they're not going to have the interior upgrades that we're going to have. So our business plan here is to compete on the interiors, be the nicest interiors, and I think we're going to be able to do that because there are a couple of properties that have done that and they've done it successfully. So that's really our business plan here. And as you can see, there's not a ton of rent upside. So again, this is not a crazy value add type deal, but we were able to get it at a reasonable cap rate and structure it in such a way where we could get a decent return. And again, I think we probably have some appreciation built in that will come to play.
It'd be hard to think that wouldn't happen. So
exactly.
Right.
So here's a good picture of the existing, actually this is a middle upgrade kitchen picture. So, but it's a good example of some of the units. So on this particular picture, the ceiling still has the drop down kind of funky, I don't know what you call that, plastic stuff that they used to put in. But on the newer units, we're taking all that out. We're putting in a nice fixture at the top. We are keeping the white cabinets with the hardware. We're putting in the stainless appliances, completing all the vinyl flooring, putting in the granite countertops. So that's a big difference there. And just as a side note, because I know I've had some people say, why don't you just go with the, respray the countertops that are there? Well, it's kind of interesting because from a money standpoint, if you're just looking to flip the property, it probably makes sense to just spray the countertops and move on. But if you're going to hold something for a reasonable amount of time as a cash flow investment, it makes sense to do your granite countertops because you literally never have to replace those countertops. So the whole goal between the finishes that we do is we never have to touch the countertops. We never have to touch the flooring. Sure, we're going to always have to touch up the paint. May have to do a little bit of cabinet work, but we want to keep those repairs and maintenance expenses as low as possible over the long run. So that's kind of key there. And then the last thing is the tub surrounds and kind of the bathroom renovation that we've done. We've seen some really good results in C properties that we're trying to push into a B market. People walk in, they see the nice tub surrounds, they see the new vanities, they see the frame mirrors, it gives it a nice feel. So we're able to push the rent, get an extra 25, 50 bucks a month because they don't want to go an extra $200 a month, but they'd like to live in something that's a little nicer. So that's kind of the business plan there. And then in terms of the detail of how we're breaking that down, you can see that here. We've got a budget for our appliances, our LVT, granite, plumbing hardware, lighting, bathroom renovation, a little bit of a contingency in there. And then we got some money for the outside for amenity improvements and landscaping. Actually, some of that amenity improvements is going to go towards our CapEx to replace some of the panels. But at the end of the day, it's going to be about 800,000, a little over 830,000 that we're going to put into the project to complete everything. And the other thing I will say too is we're putting a decent amount of money into this project, and we believe that we will probably be able to achieve better rents than what we're getting. Again, because of where we're at and because the rent growth is continued. We normally don't project that because we tend to be conservative, but just based on what we're seeing in the market, there's probably more upside here than we're projecting. I just read an article today that was talking about housing starts in the area and how the affordability crisis is, just continues to get worse. So values keep going up, incomes keep going up, and people are, in this C market, there's not a whole lot of room other than for the rents to go up because there's no new inventory. You can't build a new project for $125,000 a door. It's impossible. So that's kind of where we're stuck. Now there's new tax credit projects that are coming online, but you got to make less than $30,000 a year in order to qualify for that. And some of those are market, some of them are tax credit. So it's kind of an interesting dynamic where you've got these B and C properties like Palms at Cortez that you can't build them and there's a limited availability. And so again, we believe there's going to be continued upside there. So from a timing standpoint, typically first 0 to 18 months, 0 to 24 months, that's where we roll out our renovations and our upgrades. We're also going to do our same kind of marketing process where we bring in a better marketing plan. I think the company we're using, Weller, we talked to them about that. They've got a sharp system for really bringing in the right quality residents. So we're excited about that. And then of course we want to build back for those washer dryers starting as soon as possible. A minor point, we're going to restaff the property at market rate payrolls. They're not too far off, but $100 a month starts to add up over time. So that's part of our savings there too. So 18 to 36 months, that's when we'll go back to the lender. We'll get an extra loan based on the increased value in the property. And of course, the goal is always to take our capital off the table as quickly as possible and keep the property, keep the cash flow, and keep the upside potential. So that's kind of the basics on the strategy timeline.
Hey, let me ask a couple of questions here. Let's get to if we can.
Yeah.
One of them was, hang on here, darn it. Okay. Justin's Googled and saw the property was advertised at 1222 to 1633 for a 2-bedroom, 2-bath. And he asked the question, did we expect to get that sort of return? And I asked him where he saw that. Does that
Yeah,
ring?
there are some higher rents that we may be able to get. Of course, we're gonna try our best to get that. But again, we tend to be more conservative, and so we've taken the in-place average and said, okay, we think we can add an extra $100. Now, they are already getting our 2-year rent numbers on a couple of their units. So again, I don't want to get overly optimistic here, but yeah, I think there's some good upside there. So.
Okay, so there's that question, and yeah, that speaks to our conservative nature. What's our entry and exit cap, and what are you doing on the exit cap? Approve asked that question.
Yeah, so we're probably the one area where we're a little bit more aggressive on this one than I would normally be. So we're buying it at a 5 cap, and we're doing an exit at a 5.5, and we stress tested it to a 5 3/4. Now, normally I would probably go up a full point, but based on where things are at in the Bradenton market and the limited availability of replacement property and the flow of capital, I think we're pretty safe there. We still expanded it. There's properties trading at the 4 cap range right now in this market. So, you could make the argument that we're buying it at a little bit of a better cap rate than the market. So, but anyway, so that's where we're at on this one, in and out.
Is this property in an opportunity zone? Thomas said he looked on a map and it looked like it might be.
I think it may be. However, regardless, it doesn't qualify. And the reason it doesn't qualify is because opportunity zone requires you to have at least 50% of your renovation budget. Sorry, I'm not saying this correctly. You have to spend at least 50% of the purchase price on your renovation.
We would not
right.
do that here. That's right. Yeah. Okay. All right. I should have answered that privately. I knew that and I didn't do it. All right.
Yeah.
All right. Keep going. Sorry.
All right. So
we're about to get into the financials, Josh. So stand by.
Yes. Yeah. We'll get into the details. All right. So let's talk high level here. Purchase price, 11.4. We've got our 6-month operating capital of $250,000 that we're going to be raising. Then we've got our capital improvements, and then we've got our closing costs. Now, in our closing cost is also factored in our acquisition fee, which we charge, which is 3%. So it's about half of that closing cost. So those of you who are wondering why the closing costs are so high, that's where we put that in. And again, when we do our numbers, it's all these numbers are inclusive of all that information. So we're at about 13.1 all in, and then we've got about 9. Actually, it's about 8.8 in debt. And then the capital improvements will actually be mostly funded through a CapEx reserve with the lender. And then our equity is about $3.5 million. Let me jump to the P&L. So there's a lot of stuff on here, and I won't belabor all the details. I just want to point out a couple of things. One is that typical with most properties, the taxes are probably going to go up. Florida is not a whatever you call it, entity transfer. You can't really hide in Florida. It is what it is. So those taxes are most likely going up. We've kind of done it over a couple of tranches because typically that's how it goes. We're current at $110,000, so we bumped it $30,000 the first year, $35,000, and then we took another jump in year 3. Probably a little conservative in year 3, but I think at the end of the day, we're somewhere in the ballpark of where we should be. What was the other thing on here? Oh, yeah. So we also ran the vacancy collection loss pretty high in year 1. It's actually running at 93, 92, 93% occupancy right now. So we ran our vacancy a little bit high, mainly because we wanted to A, give ourselves a little bit of fudge factor because we always like to do that, and B, because we do feel like there's a resident demographic that probably is going to turn over when we come in and really start setting a higher standard.
It usually happens. You know, you're going to lose some of the people that have been sliding by and don't, you know, but couple quick questions. Sorry. What's our current occupancy? I think you told me it's 92, but I'm not positive.
Yeah, 92, 93. I forget what it was the last
92,
time.
93% here. And then, okay, keep going here.
All right. So trying to think what else was on here. I think that's pretty much the two main things. Yeah, that's pretty much the two main things I want to highlight there. Okay, so financial summary. So how are we structuring the deal? So we are starting with the bridge loan on this deal. We're going to refi it to a perm loan in 12 to 24 months. Now, the reason we did this, we could have gone and got a perm loan from the beginning.
Right out of gate, because you have to be 90% occupied for 90 days.
Right.
But go ahead. I'm stealing your thunder.
No, you're fine. Excuse me. The reason we did this is because the financials were pretty messed up going back 9 to 12 months. And that's part of the reason I think that the seller decided it was, you know, too much of a hassle for them. So, you know, we went in there, we looked at the pricing, we looked at the structuring, and it was okay. But, you know, it's kind of one of those situations where we said, all right, we could do this, but there's a point at which maybe leaving too much money on the table doesn't make sense. So we decided to go with the bridge. But that being said, which we do on every single bridge deal, we do a rate cap, which essentially means that we're getting fixed debt because we're saying, hey, if that rate goes up by 25 basis points year one, 50 basis points year two, we're capped. And so what I do is I just underwrite it assuming we're going to hit the cap, and that way there's no surprises. So that's how we structured it. Again, I think that we've got at least 12 months before anything crazy happens. I don't sense that the economy is going to fall apart in the next 12 months. I think we've got more than that. But again, you know, we've got that rate cap in there. We don't see anything that would tell us that valuations are going to crash and burn. But again, we're not borrowing 90%, so we've got room in there. So anyway, I know those are things that always come into my mind, and I'm sure they come into your mind when you think of bridge debt. But there's a way to structure it. And in this case, we felt like it made sense. Now, the other thing we did was we also underwrote our perm debt at 4.5%. So right now, if we went out and get perm debt, we could actually probably get it at less than 3.5%. I said 3.5. We could probably get it at 3.4, 3.3, maybe even 3.25. So we're assuming a kind of a worst case scenario on that perm debt. But the reason we do that is because we want to make sure that it still cash flows, even in a situation where the interest rate goes up and our exit, you know, we don't want to have any issues with that. So that's how we're structuring this one. And we felt like it would be best to do it. And again, I will say this, we're usually willing to take a little bit more of a risk because it's Florida. And then that's just kind of part of the market. You know, you ebb and flow with the market, but that's not the only reason. The main reason is that we felt like we were able to cap this and limit our risk and say, okay, we don't have to worry about what's going to happen with the interest rates. Even though they seem like they're still going down, but you never know. So it's worth having the insurance policy. All right, so I'm not going to bore you with all the pro forma assumptions. Again, they'll be on the slides when we send them out, but this pretty much gives you the backup detail to those line items. And then, of course, the slide that we all love to talk about, which is the returns at the investor level. Now, this is based on a $100,000 investment. We're expecting about a 5% return year one. Now, again, as I mentioned, I've got a 17% vacancy factored into that. So my goal is that we do better than that, but you know, based on those assumptions, it's 5% year one, then it goes up to 8.5 year two, 11% year three, 11.5 year four, and then 12% year five. We are expecting to return some of the capital in year two. Normally that's year three.
Okay, I responded and said year three, but anyway, there you go.
That's fine. Yeah.
All right.
And it may be the end of year two, but right.
So 30% of your capital back year two or three, and then year five, 69%. The remainder is the pro forma.
Yeah, and this one again is a little bit conservative because when we go to do our permanent financing, we will have the ability to do a supplemental on top of that in year five. So we wouldn't necessarily have to sell the property in year five in order to get the rest of our capital back. We're just doing a year 5 sale for comparison purposes so we can get an IRR. But that's kind of what we're expecting based on the projections that we have. Now, for those of you who I've talked to before, you know this. For those who don't, I'll explain it. Our goal is to get our capital back. So if you put $100,000 in, the goal is to get all of our capital back as soon as possible without over leveraging the property. Of course, we don't want to do that. So whether it's the distributions or the return of capital, we want to get that $100,000 back to you as soon as possible. The idea being, A, you've now got all your risk off the table, and then B, you can take that, reinvest it, get a second cash flow stream, and do it all over again. No money out of pocket, very little tax consequences, and that's a huge benefit from a compounding rate of return standpoint. Now, another thing that I always forget to mention too is we do cost seg studies on all of our properties. So whether you can take advantage of that immediately or not, which I know a lot of you can't because it would be considered a passive loss, you're going to see typically 5 to 7 years of tax-free distributions. So again, the goal is get your capital back to you within that 5 to 7 years so you can take it essentially tax-free, reinvest in the next deal, and do the same thing all over again. So it's a pretty cool model, and it really does add up over time. All right, so a couple more pictures here. The exterior, we've got a little exercise area out there. Oh, you know, I didn't mention this. I need to put it on the slides. We're going to be adding a dog park. There is no dog park in the area, and there's really not a whole lot of monitoring of the pet rent. And pet rent is a huge, can be a huge number.
That's just something we haven't, have you even factored any in?
No, and that's why I say, as I'm talking here, I'm realizing I didn't even put that in. So yeah, that's
no big deal. Again, under promise, over deliver.
Yep.
So
that's an opportunity there. All right. So FAQs, I mentioned that everybody has to be accredited. The minimum is 100,000. We do all the time take.
What's the pref? What's the pref on this?
8%.
8%. Yes, sorry, London. I know you've been hanging out there. Forgive me. Had a lot of questions.
Yes, 8% preferred return.
And it accrues day one, my friend.
Yes, exactly. Okay. Yeah, good point.
All right.
Yep. Yeah, I mean, I think all except for one of our properties pays distributions the first quarter out of the gate. And that was a unique situation because it was a turnaround project. So just like all the others, this one will. We're set to close in April. And
by the way, guys, this is going to sound like a used car salesman, and that's not my intent. But we oversubscribed the Cincinnati deal in about 7 days. So if you are interested, do not, I mean, just respectfully, don't wait out there very long. And if you are in that Cincinnati deal, get your money in, because there are going to be a handful of disappointed people, because as you may or may not know, you have to oversubscribe only because there are people that change their mind or back out for whatever reason. And so we have to protect the entire investment. So we all, every sharp operator always oversubscribe some. Agnes, if you've got a question, please throw it in the Q&A so we can get it answered live here. Okay. So anyway, continue. I interrupted you. Sorry.
No worries. No worries. I was just going to mention that, we're set to close in April. So we will be doing our first distribution in July for the second quarter. So for those of you who are thinking timing, that's how it'll work out. We have completed all of our unit by unit inspections. We actually had a really good, even though it was a little bit of a last minute situation with Weller, they did a phenomenal job. They went through, they actually, what we usually do is we have them do the unit by unit. So, we'll walk maybe 10% of the units, maybe 5%, depending on if it's a really large project. Then the property management company will walk every single unit. They'll take pictures, they'll give us a report. Anyway, so they came back, we sat down, we talked about what was going on. There was actually 2 units that needed to be brought back up. So there was one that had some damage in it.
Well, there was one with water damage, and this just speaks to the mismanagement. They had let it go forever. So while, last time I was there was a whole crew out there, mitigating the mold that had happened because these previous owner just let it go. And, when we see that, it screams opportunity, and it speaks to the whole environment of the management. But because the Weller went in there and did the inspection, we would have discovered, if they hadn't inspected it, we would have done it. But, you lean on your third-party property managers to do the detail and go through every single unit. You must go through every single unit whenever you're inspecting a property, someone from your team. But they discovered these, and we went back to the seller, and they paid to mitigate the bulk of it. So, well, to mitigate, I think pretty much all of it. But
yeah.
So there you go. So
we nicely held their feet to the fire.
Right. What's the split after the pref?
Oh yeah, so it's 8% preferred, and then after that, it's a 50-50 split.
Okay, there you go, Carlos.
There's no waterfall after that. It's just a very simple 8 pref with a 50-50 split thereafter. And again, that is...
Okay, we're going to get into the returns now, Chris. Let's look at have you gotten into returns yet? Or you have a slide for that?
I did. Yeah, that was a couple slides back.
Oh, yeah. That's Chris. You're a day late and $1 short, my friend. Distributions are sent out. When are they sent out?
The second month of no. So distributions are going to be the month. So it's calendar distribution. So in other words, the first quarter will be distributed in April, second in July, third in October, and then fourth in January.
There you go. Chris, I'll make sure you get this PowerPoint. You'll see that slide in just a minute that shows the returns, buddy, and the percentages of returns. Yep. Chris is one of our students, so I can tease him.
Okay, so a little bit about us. Again, I probably talked with most of you guys, but for those of you who may be newer to us, we obviously love to have new folks that are looking at REM as a potential sponsor and potential investment. So want to tell you a little bit about us, kind of 3 things that we have sort of pulled out as unique sort of core competencies. One is our experience. We feel very strongly that in a market like this, where you definitely are at the high end of the market, some would say the top of the market, having the experience of decades of ups and downs and understanding how these things flow is important. We've closed, it says here we've had 300 million, but it's actually probably closer to, between all of us, maybe 2 or 3 billion. I mean, literally, we've closed a ton of deals over the last 20, 30, even 40 years. So I think that's important. That's one of the things that we feel strongly about in terms of reducing risk, because again, it's not just the deal, it's also the operators that are running the deal that can add to or subtract from that risk. And then of course, we're conservative. Hopefully I've shown you kind of some of the ways that we do that. One of the things I didn't mention is the stress testing that we do. So whenever we look at a deal, we want to stress test that deal so that it still cash flows with a 25 to 30% vacancy. And we do that in year 1 and we do it in year 5. The reason we do it in year 1 is because we want to know day 1 that we've got that fudge factor. The reason we do it in year 5 is because it keeps us from over leveraging the property when we go back to do that supplemental loan. And I talked about that. It's great to get a good return, but if you're over leveraging at the end of the day, it doesn't make any sense. You don't want to give up your capital to try to squeeze out an extra point or two. So we tend to be pretty conservative in terms of that respect. And we like to leave money in the deals. That's why we've got the working capital. That's why we don't, we don't plan to run that occupancy at 99%. It's just not realistic. And then of course, being diligent is very important. As Rod mentioned, whether it's us or our third-party property managers, we walk every single unit. We look at every single piece of the puzzle and make sure that we understand what's going on. We do our homework in the area. We visit the comps. We know who our competition is. And it's something that takes perseverance. It doesn't just happen once. It's something that we have to continue doing week in and week out, month after month, to make sure that we execute for you on that business plan. So those are kind of 3 distinctives that we have. And then kind of going back to what I was talking about, the risk-based approach, our thought is you could get a 30% return potentially, but if you're having to risk 100% of your capital, it doesn't make sense. So we're more of the mindset that, hey, we'd rather get a little lower return. We'd rather get a 15% return as an example and risk 1/10 of what we would risk otherwise. Now, I will tell you that our goal is to risk nothing, as little as possible, to get the returns that we're getting. And that's why we've got all these fail safes. We've got the stress testing, we got the working capital, we got the leverage. It's all built in so that hopefully we're taking almost no risk to get that return. Obviously there's risk, we all know that. But anyway, So as I mentioned, the stress testing, we like to identify the risks in the market. So kind of going back to the interest rates, we don't want to be at the whim of the market or the whim of politics. So we've got those rate caps in there. Lower leverage. We could have leveraged this to 85%. We're not doing that. We're making sure that we pull that back. So we've got some fudge factor. And then of course, as I mentioned just a second ago, we've got a lot of experience and we're conservative with our underwriting. So hopefully you've been able to see that, but those are kind of some core aspects of how we look at it, not just from a, find a deal, try to make some money and go on to the next one. It's a little bit of a bigger picture. And for those of you who've been with us on other deals, you also know that we look at it both from a deal by deal basis, but also from a portfolio basis. And we don't want to be overexposed in one particular market or one particular area. Kind of like how we look at jobs, we want good diversification. So we hope that, those of you who are new or continuing with us, that you will, feel the same way and be disciplined about your investing. So,
Robert, there was one open question. Did we factor in a disposition fee for anything on the disposition side?
We don't. So the only two fees that we have is the acquisition fee and then the ongoing asset management fee, which is, I forget what it was, but it's about $30,000 a year, I think. And that's it. We have no disposition, no refinance, no construction. Just we've chosen to keep it simple, and it's really based on performance at the end of the day.
Yeah, and just so you know, we're looking at about 250 properties to find one. Now, luckily, we're in a unique position that, with all my students and people sending us deals from literally all over the country because of our reach. We get a lot of deals across our desks. But we are looking at a lot of them right now. It's and because we're very, very picky. Now, the bottom line is we do a webinar like this just to start the conversation. And if you are interested in investing, you'll get the email with the portal that you can register. You can get on our calendars to have a conversation if you've got any questions whatsoever. And like I said, if you have an interest, don't delay. At least get on our calendars and chat with us, because that Cincinnati deal was actually double the size of this raise, and it happened in a week. So very important that you get involved. And like he said, we're very conservative. So, again, the goal is to underpromise and overdeliver.
And not saying that you guys.
Yeah, the answer is yes. The answer is yes, Michael. If after 5 years we decide to sell the property, profits are also distributed to investors. Absolutely, yes.
That's good. And I was just going to say that not that this would be the only reason to invest, but February, taking a trip to Florida, writing it off.
Well, there is that. There are some fringe benefits. There are some fringe benefits to having an asset in Florida, for sure. Anyway,
all right.
Thank you guys for joining us. If you have any additional questions, just pop us an email. You've got Robert's email here. I'm Rod at rodcleef.com. I'm Rod at remcapital.com. Is it REM Capital or REM Capital Partners, Robert? Because I see
both.
the email here.
We have both.
You have both. Okay, there you go. All right, there you go, guys. Agnes, if you didn't get your question answered, give me a call or I'll call you. I was hoping you'd type it, but anyway, we will wish you guys a good evening and look forward to working with those of you that are interested.
Thank you all.
All right, guys, take care.